Since the financial crisis, markets have slowly but inexorably been changed by regulation. What does it mean for one of the market's biggest actors, asset managers? With me to talk about it is Arjun Singh-Muchelle, Senior Advisor in Capital Markets at the Investment Association. Arjun, welcome.
Thank you.
So what is the cumulative impact of all these layers of regulation?
Well, insofar as the buy side is concerned, there have been two unintended consequences. One in regards to monetary policy and the low interest rate environment. If you look at from 2007-08, once interest rates had gone down, we on the buy side had record sales of fixed income funds. So we've been increasing our holdings of corporate bonds and sovereign bonds and so on. But one of the other unintended consequences of prudential regulation placed upon banks has led to a de-risking and a de-leveraging of bank balance sheets, precisely in corporate bonds and sovereign bonds. So this has led to an asset class mismatch between the buy side and the sell side.
If it's becoming a bigger part of the market, earning more revenues from it, does this, by definition, make the industry systemic?
It's always important to recall that the revenues generated by asset managers on markets are not revenues for asset managers. They are returns generated by our clients. Revenues generated by asset managers come from the sales of funds. Now, the systemic question, as institutions and businesses, asset managers are not systemic. And the reason for that is, if you look at the balance sheet of an asset manager and compare that to the balance sheet of a bank's balance sheet is normally a multiple of an asset manager's balance sheet. And the reason is that the assets managed by an asset manager do not sit on our balance sheet. They are held in segregated accounts by a custodian. And what that means is that were an asset manager company to go down, the client's assets would never be touched. That does not mean to say that we do not bring any sort of risk. As any economic agent on financial markets, we bring a certain element of risk. But those market-based activities are or will be mitigated by MiFID going forward. And some of the other areas globally that regulators are looking at, of course, is whether you can have a run on a fund. Now, UCITS is a great European success story, and one of the tools provided in UCITS is to manage a redemption.
Now, if the banks are actually moving out of the market, you're becoming a bigger part of the market, there's opportunities there to maybe participate directly, with a counterparty and bypass that intermediary. But what are some of the trade-offs here?
One of the bigger trade-offs that we see in financial markets is, of course, market data. What this assumes is that there's a quality of access to market data and the quality of the ability to pay for market data. Now, if you use the equity market as an example, the price for market data have been rising for a number of years now, where the revenue generated, for example, by the London Stock Exchange from market data and non-transactional services is now a greater proportion than it's ever been previously. Now, if this model was applied to fixed income, this would increase frictional costs for asset managers, which have a direct impact on the revenues that we can generate for our clients.
Arjun, thank you very much.
Thank you.